In this video, I'll be revealing the simple retirement tax strategy that many advisors say and academic research shows can help save you thousands, and how using low income years to do strategic Roth conversions can prevent the high bracket taxation and possible Medicare penalty surcharges that waiting until RMDs begin can create. Through over 15 years of working with many retirees on Roth conversion cases in different tax landscapes, I've discovered that those who strategically move money to Roth accounts in those low income years can save tens of thousands to potentially hundreds of thousands in avoidable taxes compared to those who let those pre-tax accounts build up until required minimum distributions force them to take money out. If you're new to the channel, my name's Justin. I own a financial planning firm in Lewisburg, Pennsylvania, where we help retirees all across the country make smart financial decisions and help them make use of strategic Roth conversions where appropriate to reduce their taxes. That's exactly why I'm making this video today, to show you the tax strategy or tax hack that most retirement plans overlook and how strategic, specific Roth conversions in optimal windows can deliver savings that traditional reactive tax planning usually misses. So let's break this all down. And before we jump in, I do want to say I've spent a lot of time in other videos on my channel detailing all the factors that should go in to doing Roth conversions, who it's good for, who it's not good for. It's a highly personalized strategy, very nuanced. Not everybody is a good candidate to do a Roth conversion. So this video is going to be for those that we assume that we're past that. You are a good candidate. Usually that's retirees with large pre-tax balances, low income windows, and higher expected future tax brackets. So if that's you, then this strategy can be a big help. So with that foundation in place, let's break down some of the specifics here. So this first section I'll call the overlooked tax strategy or tax hack that good planners recommend. And now most retirees don't hear about these strategies a lot because most financial advice and especially tax planning advice is backward looking, meaning just looking at optimizing taxes for this year only instead of the bigger picture, which is reducing taxes over your lifetime. And strategic Roth conversions during low income years flips this around. When you convert those pre-tax dollars when you're in a lower income window, you permanently lock in those savings. That's what we call tax bracket arbitrage. That's what it's all about. And Roth conversions done well, I'd say are just simply buying out the IRS's share of your pre-tax balances at the lowest possible price or lowest possible tax cost. And for the right people, that can mean tens of thousands to hundreds of thousands in less taxes paid over their lifetime or over their spouse's lifetime, over their heir's lifetime, whatever their goal happens to be. And now, of course, the next question is, well, then when's the best time to do this? How does this work? That's where the low income window comes in. And that lower income window is usually defined as the space between right after you retire up until required minimum distributions begin. So for most people, it's from age 60 up to age 73 or 75. And those are often the lowest taxable income windows or years of your life. You're not receiving a paycheck anymore. You may not have started Social Security, and your portfolio withdrawals are more or less optional, or they can be strategically done to minimize the tax impact. And here's where things get a little bit better. Just this year, if you're 65 and over, you can take advantage of the new senior deduction, which lasts until 2028. I did break this down in another video and ways to take advantage of this in more detail, but this deduction can create even more empty space in those lower brackets to do strategic Roth conversions. And for most people, this window lasts about 8 to 13 years, just depending on when you retire, when you take Social Security, if you have other income, if you have pension benefits. Again, this is highly, highly dependent on personal circumstances. But once RMDs start at age 73 or for some age 75, then this window gets permanently slammed shut. That's why waiting until RMDs begin is suboptimal. You lose the chance to take advantage of this window and capture that lowest possible tax cost. And to expand on the point here of lowest possible tax cost, in a fantastic paper by Edward McQuarrie titled "For Whom Are Roth Conversions Most Beneficial?" he pointed out that if the lower brackets, the 0, the 10, the 12% are filled with a conversion, your effective rate or average tax rate could be about 8%. Relative to a future rate that could be 3 times as high. So this scenario produced the greatest and quickest payoff of any examined. So essentially what he's saying is that if you're going to do a conversion, you want to try to get that lowest possible tax cost that you can. Now, this doesn't necessarily mean that if you're outside of that window or if your tax cost is a little bit higher, that the conversion doesn't necessarily make sense. But again, highly nuanced. All these strategies vary by individual, but all things being equal, we want that lowest tax cost. And to give you a quick example of this, so I was working with a couple earlier this week, married filing jointly, both over age 65. And because of that new senior deduction I mentioned earlier, we were able to convert $20,000 for them at the 12% marginal bracket instead of the 24% that they're going to pay later on. For them, that's an easy $2,400 in tax savings for this year. And we plan to repeat this strategy over multiple years so those benefits can really start to add up and stack onto each other. And that 12% difference between the tax rates, between the 12% bracket and the 24, that's what we mean by tax bracket arbitrage. That's what it's all about. If they waited until RMDs began, then that same 20,000 would have stacked on top of Social Security, on top of their RMDs, and then they would be paying 24% on it. And so that's the power of this window. Unless you do things today that would become mathematically impossible later on. I'd also say this is a really good example of what I call picking up the low-hanging fruit. They had the room in that 12% bracket, especially because of the senior deduction. So we want to be able to go in and capture that. That's a quick, easy win. We want to scoop up that $2,400 in tax savings. And you may have a really large pre-tax balance and hear this and say, well, converting 20,000, that's not really going to do anything to reduce my balance. It's still going to grow. Totally understand that. I'd say the goal of Roth conversions isn't to try to convert everything as fast as possible. It's about getting that lowest tax cost. You may not be able to efficiently convert your entire balance. That may not actually be possible, but you can scoop up those easy wins and capture that low-hanging fruit by being strategic with it. And now, before we go any further, I want to clear up one of the biggest misunderstandings about conversions, the idea that you're somehow losing compounding if you pay some of your taxes earlier. I've heard this quite a few times, and a lot of people misunderstand how this works, even people in the financial industry. Some people will say that, well, you're removing dollars by converting that could be compounding, and I totally get how that sounds logical, but that's not really how the math works. If the tax rate today and the tax rate later are equal, then the after-tax result is identical. I'm going to show you an example here. So let's assume we have $100,000 invested, 7% growth for 20 years, 22% tax rate today, 22% tax rate later. We'll look at the traditional IRA example. 100,000 going in, no tax paid because it's all deferred. After 20 years of growth at 7%, the value is $386,968. And then at withdrawal, tax at 22%. So the final spendable amount, $301,835. Now let's look at the Roth example. Same 100,000, but taxes are paid up front in the Roth. So 22,000 is gone. And then here's where people will get tripped up. They'll say, well, now we have a lower balance going in. There's only 78,000 being invested. So we've lost money. There's less to compound. Well, the value after 20 years at 7% is $301,835, but there is no tax at withdrawal. So the final spendable amount is identical. There's no difference. There is no lost compounding. So the only thing that matters here is whether your future tax rate is higher or lower than it is today. That's it. In the traditional IRA example, if we were able to withdraw at a tax rate lower than 22%, then that final spendable amount would be higher. That's the win. That's what we mean by tax rate or tax bracket arbitrage. That's what matters, not performance. And doing this all correctly, of course, leads into one of the biggest and most obvious advantages, which is shrinking those future required minimum distributions, or RMDs. Every dollar that you're able to convert strategically is one that doesn't show up as an RMD distribution later on. If somebody converts $50,000 a year, for example, for 10 years, then that's potentially $500,000 that's removed from their traditional IRA or pre-tax 401k before they're forced to take distributions. And of course, those smaller RMDs mean lower lifetime tax burden, lower chance of Medicare IRMA surcharges, less Social Security taxation, and what we call more income smoothing over your lifetime. If you're watching this and you're curious about how this all fits together and you want to see exactly how this fits into a real retirement plan, not just the tax part, but the investment part, the income part, managing withdrawals, click the link in the description below the video. It'll take you to a page where I walk through the full process that I use with my clients, and there will be a link there to book a call with me. If I can help, just let me know. And I mentioned reduced RMDs being an advantage, but along with that is the reduction in possible Medicare costs or avoiding that dreaded IRMA. A lot of people have really strong feelings about this, especially if it's a surprise. It could be a particularly nasty surprise. If your modified adjusted gross income is $1 over the threshold, then you have to pay hundreds more or thousands more in Medicare premiums because of that. So doing strategic conversions during the low income years can help flatten that income curve and reduce those spikes that could cause you to jump into those IRMA brackets. And now I wouldn't base your whole strategy around avoiding IRMA or saying that everybody needs to convert to avoid IRMA. Again, all these strategies should be highly tailored to the individual, but it is a consideration. So where you can avoid it, we want to help you avoid it. And of course, the biggest advantage, one that everybody already knows about, is that the tax-free growth advantage of having money in that Roth IRA. Once money goes in there, all the growth from then on is potentially 100% tax-free. That's the obvious benefit. But one of the things that I don't think gets talked about here, and one of the angles, is that the control that not having to pay taxes on that money can provide. I have to give a shout out to one of my former professors, Dr. Dave Yeski at Golden Gate University. In one of his classes, he taught us that the utility of an after-tax dollar is higher than a pre-tax dollar. And I thought that was a really interesting concept because nobody had ever explained it to me like that before. So the pre-tax dollar, there's a lot of uncertainty around it. You don't know exactly what tax rate you're going to pay. Tax laws could change. But once you have that as an after-tax dollar, well, you've removed a lot of that uncertainty. You've basically bought yourself control. And I think that's a very underrated concept that I don't think gets incorporated a lot when we talk about Roth conversions and planning. But it's definitely something that I want to emphasize because I do think that benefit, that value of having control, removing the uncertainty around that dollar, I think that can be very underrated. And now that we talked about all these different possible benefits, let's look at how to tie this together in a comprehensive framework. So here's the framework that I use with my clients. Here's what I think about and want to incorporate into the strategy. I think this is where most retirement plans fall short because conversions are never about let's just pick a number and fill up the bracket. It's a coordinated, detailed process. I think the concept is simple of converting, but the planning required to do this well should be nuanced and should be very, very thorough. And step one is identifying the low income window. That is the starting point. We want to map out those years between retirement and RMDs. And then we want to layer in your Social Security start date, pension start dates, part-time work if you have that, temporary deductions like the senior deduction I just mentioned, and your expected withdrawals. And also, if you are retiring before 65 and you're using Affordable Health Care Act subsidies, we want to take that into consideration as well. That could be a reason why you don't want to convert for a couple years, right? All these things make a difference, but this gives us a clear picture of the years where your taxable income is the most controllable. Step two is determining your annual conversion capacity. This is the real math part and where we calculate exactly how far you can convert before you hit that next tax bracket jump. The IRMA tier thresholds, we definitely want to avoid that where we can. Social Security taxation thresholds, if we can minimize that. And of course, any state tax considerations. Different states tax retirement withdrawals or conversions differently, so we want to take that into account as well. Most people will underestimate how quickly these landmines can shrink a lot of their conversion space. Number three, we want to convert systematically, not randomly. This is where the maximum savings can happen. Instead of doing one big conversion or let's just find whatever's left at year end, we want to fill the available bracket space every single year intentionally where we have those windows open. So I would think of it as bricklaying. We're just laying those bricks one row at a time methodically. And this is how you can end up converting a couple 100,000 instead of just maybe tens of thousands because it was a haphazard and quick decision. Number four, you want to adjust this every single year. Income changes, markets change, tax laws change like they just did. A conversion plan is definitely not, at least a good plan is not a set it and forget it. Every year we want to rerun updated tax projections, making sure that we're taking into account how close you are to those IRMA cliffs, RMD forecasts, any new income sources that you may have, like part-time work, rental activity, also taking into account your taxable interest income. I'll come across a lot of retirees that have large balances in CDs or money market funds, not realizing how much bracket space that can fill. Also, your dividends in those non-retirement or brokerage accounts. We have to take all those things into account. And this can prevent the two biggest mistakes: over converting into higher brackets or under converting potentially and leaving some of that low-hanging fruit on the table. Number 5, last but not least, we want to optimize withdrawals in parallel with everything else. So conversions don't exist in a vacuum. We want to coordinate that with everything else. Your withdrawals that you're taking, number 1, to live your life, because that's the whole point of retirement in the first place. I've said many times, we don't want to let the tax tail wag the whole financial planning dog. Number 1 goal is to enjoy your life first. And if we can save taxes along the way, that's great. But if we're doing this strategy, we want to make sure we are coordinating this with how much money you want to take out and want to spend. Other things as well, like capital gains, tax loss harvesting, qualified charitable distributions after 70 and a half, if that's something that you like to do. Everything has to fit together. And I think this is where people will realize that tax planning, good tax planning, isn't just, quote, one Roth conversion. It's a lifetime income plan and withdrawal strategy. And I'd say this is why just one-off conversions rarely matter that much. The compounding effect and the real savings effect happens through a multi-year framework of doing this intentionally and strategically. And now that you understand a lot of the benefits of this, if you want to see how I bring these pieces together in a real retirement plan, taxes, investments, withdrawals, long-term planning, and you're thinking, especially this stuff is complicated, I don't want to handle this all on my own, click the link below. It'll take you to a video where I walk you through the full framework that I use with my clients. There'll be a link there to book a call with me if I can help. Just let me know. Glad to do it. Thanks for watching as always, and I will see you in the next one.